Good afternoon, everyone. And I thank Charmaine and the whole team for organizing this wonderful event and to all our panel members who are here with us. Uh, 2023, a year rising from the shadows of COVID, and we find ourselves in middle of a plethora of changes happening all over in the tax landscape. Recently, the G20 meetings concluded in India, and India as a very welcome leader for such initiatives, making a mark even in COP26, 28, and further on. And there's an increasing level of ESG and environment and carbon credits everywhere around. With all this, we are seeing record digital payments coming in our economy. The number of return filings on the income tax side is going up, and more number of systems being introduced, faceless assessments, e-appeals, and the interplay of technology coming up in a big way. Along with the tax landscape, the eminent speaker before me also touched upon the changes happening all over around Ind AS and the new accounting regime which is happening, and so many other ones in the global landscape with BEPS and the minimum alternate tax of 15% coming up, and so many ones. One thing I would like to put as an observation is that the level of awareness with all of us here with India as an investment destination, and the index, which is about ease of doing business in India, is the awareness of this particular concept is increasing in all of us in an average Indian in a fairly larger way, which is a welcome change. And here, to continue this thought further, we have with us in the panel industry representatives from varied streams. And we are in this particular panel discussion going to throw light on how is industry's perspective on the different changes and the different controversies are relating to tax and investments which are happening all around us. So welcome once again to all our panel members, and we could just start our discussion now. So we welcome Mr. Manik Malik also. He's also joined in as a speaker. Great. So I think this So we have with us Mr. Abhishek Sharma, and sir, this is mainly to do with the healthcare industry, and rising from COVID, we understand that the industry which you represent has been a part of all our lives in a fairly bigger way, and also a booming sector in the last couple of years. So we would like to begin by asking you first, your outlook or the outlook of the healthcare industry towards how the taxation and FDI policies been, and particularly in healthcare, but even in the related segments of medical devices, insurance, which are somewhere connected with the healthcare industry. So please.
Thanks, Yogesh. Thanks, everybody, and dear panel members. Happy to be here. As all of us have seen and experienced healthcare sector, especially during COVID and post-COVID, and have started actively participating in preventive health care, and at least getting tested more frequently than what we were doing before COVID. Obviously, growth in healthcare sector is going to be there because of this, but at the same time, there has to be enabling environment, and there has to be right kind of I would say policy push required to make it affordable and make it available at every part of the country and obviously means take it out of the metros and the tier 1 cities in India. So with that kind of backdrop in mind, and also to fill the kind of gap India is having in terms of bed availability per 10,000, or doctor availability per 10,000 bed compared with its peers, and also the other skilled healthcare health worker requirement like paramedics or nursing requirement. Policy push is required. And what comes to my mind is that we need to take healthcare towards tier 2, tier 3 cities with the right kind of fiscal incentives, because obviously healthcare has to be affordable also. So quality healthcare being run by large corporate chains and the premier government hospitals, which are basically shouldering the load, are basically concentrated in urban areas. So what about the Bharat, or the rural areas, or the areas now which are very well connected with the highways and the tier 2, tier 3 cities connected with the airports and railway network. So there, if someone has to have a quality hospital available, they would need some kind of incentive, because the ability to pay may not be there that much. The gestation period of turning EBITDA positive and also getting the capital back in due course would be relatively longer than urban pockets. So some kind of direct tax intervention will be required. What comes to my mind personally is the kind of the new manufacturing setup, what basically have been offered some kind of special tax rate, especially which has been set up between I think 20 to 24 period. So that kind of a lower tax regime. And also since the healthcare is going to be taking its own time to get profitable, so especially towards medical equipments, the quality medical equipments, what basically are required in any corporate healthcare setup, they can have some kind of like we used to have earlier days, 200 or 300% depreciation over a 3 to 5 year block kind of a thing. So to my mind, if this kind of policy is there, it will take quality healthcare with some kind of filters put in, like minimum 200 bed NABH accredited, and out of 200 beds, say minimum 20% should be your critical care ICU beds. So this will push private sector investments in setting up hospitals, away from the urban pockets towards tier 2, tier 3 cities. And also this will help in terms of employment generation where it is required, because nowadays the entire mass is getting concentrated towards the urban pockets, metros and your state capitals for employment. But what happens in healthcare setup is that 5 to 7 direct employment gets generated per bed basis, if you see. So any hospital which is being set up with a 200 plus bed kind of capacity will give you roughly around 1,000 in terms of direct employment. And also it takes care of the local microeconomy. So kind of give fillip to a lot of other allied activities, trading, and the pharmaceutical companies. Nowadays the supply chain is already developed to cater to all these things, and real estate also then slowly gets into shape in and around that area. So net when we are having a time horizon of 5 to 10 years, this kind of direct fiscal push will help. And to take care of the affordability aspect, obviously the health insurance what we opt for, there the limit can be increased to my mind. And just thinking how to make some kind of, gifting health insurance policy to someone, if that can also, be added to taxpayers, so this will act as a incentive to increase the coverage of healthcare insurance. So affordability bit also will get addressed, and we can have a sustainable 15% plus CAGR over the next 5 to 10 years, and become better in terms of bed availability, doctors availability, per 10,000 bed parameter, and take our leap, towards more, developed country in terms of healthcare index.
Thank you, sir. Thank you, Mr. Sharma. So this is the perspective from the healthcare industry, one of the booming sectors. And just like I was saying, in the last couple of years, particularly a few terms which have really sunk in a lot is Make in India. And we have the representative of manufacturing industry. So we go to Mr. Shailendra Jindal. Sir, please tell us a bit about how the manufacturing industry has been, what's your perspective been towards the tax changes which are happening, and some of the PLI schemes and other incentives which we are seeing, and particularly in the atmosphere where we hear at least that the attempt of the administration is to remove the incentives and go towards a simpler taxation regime. How the PLI and other incentive measures which are happening in middle of all this euphoria, how does the manufacturing industry feel towards that?
So thank you, Girish and Abhishek, for setting up the tone. So before I proceed from the manufacturing sector, let me first briefly talk about what are the incentives available. So as we all know, India is one of the fastest growing world economy and likely to become the third largest economy by 2027, reaching $5 trillion, maybe $20 trillion by 2047. So for that perspective, growth in manufacturing sector is must for India to grow. And government did realize this necessity and come up with the plethora of incentives to boost the manufacturing. Like in 2014, India launched the flagship program, Make in India, to boost the facilitate the investment and foster the innovation. So industrial incentive in India follows the partnership approach between the central government and state government. In 2020, government launched this production link incentive scheme, PLI scheme, in 10 key sectors, with the budgeted outlay of 20 billion. And the key criteria factors includes the investment commitment and capacity creation and the incremental turnover. And these incentive schemes come in an optimal time, when the global investors were looking at the diversification of their manufacturing base outside China. So these are the central schemes available. And then the many state government also offer the incentive schemes based on the, say, capital-linked incentives, which is percentage of investment, subsidies are given, expenditure-linked incentives, where the subsidy is given based on the power tariff subsidy or the stamp duty reimbursement. Then we have sales-linked incentives, where subsidies are given by way of reimbursement of the SGST or the turnover-based subsidy. And then we have a tax-based incentive, like lower corporate tax rate, about 15% plus surcharge, etc., for the new manufacturing unit with a sunset clause. We have tax-free export or the export incentives. We have a concessional custom duty or a deferral custom duty for the import of capital goods or the input used in the manufacturing. And we have a accelerated depreciation for certain sectors. We have deduction for the R&D expenditure. So there are a plethora of incentives available. But the question is, are we manufacturing sector industries, optimally encash those incentives? So I would like to ask from the audience, are we able to optimally utilize this incentive? I'm sure the answer is no, because there are challenges at the execution level and the administration level. There are unclear conditions or with the abnormality of the conditions which lead to complexities, lead to litigation. The compliances required are too complex. There are delays in the disbursement of the approval for the incentives. even in the state incentives, the quantum incentive is too small because based on the sales made within that state, net of the input tax credit. So there are challenges on those behalf, which need to be addressed. Although the government has taken directionally the right perspective of rolling out the policies, but at administration level it has to be, So that's where the industry is filing a challenge because they're not able to optimally encash those incentives, I would say.
Sure. Thank you. Thank you, Mr. Jindal. So, with this, let's now touch upon the foreign investments in India. And particularly, it's recently concluded G20 summit. And before this, we heard a whole lot of, industry meetings which happened, and including the tech subject also which happened there. The point is more towards the foreign investors, how they look at India. And making an investment is one thing, and then to be able to deploy manpower and have expats and have people regularly to monitor, to manage and to operate that investment in India is something which is a topic of interest, I'm sure. We have with us Ms. Divya on the panel. I would like to ask her particularly about, and coming from Maruti Suzuki, one of the most successful, Indian foreign investment company, I would say. So, Ms. Deva, what's your perspective towards this particular aspect being of significant economic presence and the foreign investors when they are already having successful companies and investments running in India? How do they see on this particular piece, please?
Yeah, thanks Yogesh for the kind words and the question. With respect to the foreign direct investment is concerned, the ask primarily is certainty of the tax laws. And this government has definitely done that by assuring no retrospective amendments. And there is clarity and well in time, information about what is there to be next. So of course, this is a welcome move by the government. As regards the SEP, I'm sure it's a pain point for many, but just to give you a background, see, digital business is the new way of doing things. And of course, in order to cope up and have their share of the pie, the tax department is also making a lot of amendments in the tax laws. While trying to tax the digital business, they amended the tax laws to get in the provisions of SEP. As a result, what's happening is that every supply getting made to India, where it's more than 2 crores, which is a very small threshold, everything is getting taxed in India. In order to avoid that, what you need to do is to have treaty documentation collation. So, this has put a lot of onus on the business, and specifically with us, what we are feeling, because we have a very huge vendor base. So, this has created a lot of paperwork burden on the company as such. While it is difficult to roll back these, our ask has been, if we could have a simpler, lower rate, just like, a 194J or 194C, that in case we are not able to collate it, there is a practicable rate at which, we can comply with these provisions. Because 40% gross is, let's face it, no business has that kind of margins today. So this is what it is. Another thing that we keep hearing, Yogesh, is that, data is the new oil. So while government is also trying to, capture their share of oil in this. So what's happened there is that now they are asking that all 10F has to be done online, filed by all the non-residents. And for that, they need to have a PAN in India. And if they don't give us 10F, we cannot give them treaty benefit. Now imagine for a business as such, you are compelling the non-resident vendor to take a PAN in India, do a 10F online filing, so that treaty can be extended. So these are a couple of, impracticable onuses that have been put in business. Even the tech is not able to help us because this is more in terms of collation. But yeah, looking forward to some changes in this aspect.
Sure. So I think both our the speakers, Mr. Jindal and Divyaji, also saying pretty much, a statement that incentives are welcome, it is happening, but at a compliance level, there are complexities and somewhere difficulties which need to be sorted. It is certainly a desire and a request from everyone. The industry need to be promoted. Mr. Sharma also mentioned it. However, there are anomalies which needs to be looked at very carefully and corrected before the real effect of the tax as a investment guiding tool can actually be fructified. Moving on to another aspect of taxation, and this is, perhaps one of the most interesting aspect of taxation is litigation. And perhaps tax is not tax if litigation is not there and controversies are not there. But within that, we see the changes and some sort of a progressive steps being taken around faceless assessments, e-appeals, and a whole lot of exercise that we are seeing that while the taxpayers and the assessees are becoming more and more digitalized, so is the department happening. We have with us Mr. Anuj, and sir, please tell us a bit about how's your experience been on these so-called progressive measures about tax litigation, and how do you see it moving further?
Good afternoon, everyone. So as Mr. Chandan has put a lot of light on the automation side, what is required from industry perspective. So when we talk about the e-assessments or e-appeals or faceless appeals, so this is basically government's initiative to go into that digital format. Nowadays, even the government cannot survive without using the technology. And the objective to bring in the e-assessment and faceless appeals was to kind of do away with and bring in more accountability, transparency, and efficiency. So this e-assessment was actually brought in, I think, August 2020, and just after 1 month, which is quite quick, the faceless appeals were brought in. So we have been handling the assessment for a number of years. So every time it was compilation of the documents, preparing the submissions, visiting the authorities, placing the same before the authorities. So this actually took a lot of time, and for obvious reasons, there were certain things which the government wanted to eliminate, which no SSE actually liked. So with this, the National E-Assessment Center was formed, then regional assessment centers were formed, and the assessment units. So who was supposed to take care of this, but there was no interaction between there is no interaction which is supposed to happen between the SSE and the authorities. With this mandate, this entire thing actually came up. And similar is the faceless appeal scheme, wherein the appeal is to be heard digitally. All the assessments, appeals, everything has to go in digital format without any interaction. If we look at the assessment spending, so presently probably the number would be more than 4 lakh, which are lying with the CIT appeals only. If we look at the last economic survey, the pendency was around 3.25 lakh. Before CIT, then the number was around 1.75 lakh with the tribunals. And 2/3 of the litigation actually that belongs to direct tax when it is before the tribunals or High Court or Supreme Court. So with these high numbers, which anyways was supposed to and bound to increase only, this was brought in. However, we see there are certain practical difficulties, although these can be considered as teething problems. Whatever we bring in or some changes happen, initially there are certain hiccups and kind of observations, reservations. So, just like in case of assessments, only 3 adjournments are allowed. Same is the case with appeals also. So the window actually pops up 2 options. One is the partial submission, the other is full submission. Even a letter of adjournment, that is considered as a submission because the portal doesn't understand whether that's an adjournment sought or that's a submission. So after 3 attempts, the window gets closed. So despite of this inherent right vested with the SSE, this actually doesn't allow the SSE to avail that right in totality. Similarly, for the assessing officers, without understanding because there are definitely transfers which keep on happening, you don't face the same officers for every year. So the difficulties or nitty-gritties in any business, when the assessments were happening face to face, those were quite understood and made understood to the assessing officers. Whereas in case of e-assessment and faceless assessments, it has become of late more of a routine thing, which was supposed to happen physically with less of aftermaths, but now the same kind of work is happening digitally, but the routine kind of additions, apart from that, those additions which were not supposed to happen, they were also getting made in the assessments. Similarly with CIT appeals also, if this doesn't been dealt with, it is going to only increase the load of tribunals further. As of now, tribunal is not faceless, or the hearings before the higher forums, be it High Court or Supreme Court. But anyways, this is going to stay, and technology is going to be used more and more only. Hopefully, with the experience the officers and the commissioners, the authorities, they are gaining and getting out of this, probably some more appropriate measures would be taken in future. So this is going to stay.
Thank you. Thank you, Anuj. And now to complete the thought of tax litigation and the whole policy framework further, we have with us in the panel Mr. Umang Dhingra. And sir, one question which a lot of MNCs and a lot of companies are keen to know about is transfer pricing. So how, in your experience, do you see the landscape of transfer pricing provisions has evolved over the last couple of years particularly? And how's your experience been so far within this particular domain of taxation?
Thanks, Yogesh, for that question. See, if we see the journey of transfer pricing law, which started in India somewhere around like 2 decades back, so there have been two sides of the same coin. One, there's no denial of the fact that transfer pricing as a law have matured. While we started with most of the additions being on account of comparables, which as on date have matured enough, and the issues are much larger, like intangibles, AMP, royalty, and all those kind of issues. However, in the interim, what has happened is that there is a lot of backlog of litigation which has got generated. So just to put some statistics, if you're a multinational operating in India and if you get an order in hand, there is extremely low probability that it won't have a transfer pricing addition, number one. Number two, even if you see in the terms of quantum, it's quite obvious that the transfer pricing addition in the numbers is as huge as 60 to 70% at least of the total addition being made. And just look at our act. How many sections do we have in the act which deal with transfer pricing? I don't think there would be more than 10 or 12 sections in the entire act, having like hundreds of sections which deal with this. So the question arises that how can few pages of the law create such a mammoth litigation? So I'm quite amused by the fact, but when I deep dive into it, there are two major reasons which has led to this. One is the fact that there has been extremely limited guidance from the government. So internationally you have OECD guidelines, UN guidelines, which are religiously applied and relied upon. But as far as India is concerned, there are no particular guidelines which the SSC can actually look up to. The second is the fact that transfer pricing is, strictly speaking, what I personally feel, not a tax law but an economic law. So when the officer has to step into the shoes of the SSC, he has to step into the shoes of a businessman to appreciate the ground realities. Until the time he would step into the shoes of a businessman, he would not be able to get the factual understanding of the business model as to why and how it operates. So being extremely subjective in nature, this is the first side of the story, that there has been a lot of litigation which has been created in last 2 decades. But now turning to the positive side of things, that is the government taking steps to sort of resolve this litigation or proactively look at it as to how it can be mitigated for the future. So yes, so few days back I was going through this report issued by CBDT on the progress of the advanced pricing agreements, the APAs. So APAs have almost completed like 10 years very recently, and it was quite pleasing to read that report that the recent results show that India is signing advanced pricing agreements to the tune of at least 95, 96 agreements in a year. So which is like one of the highest recorded numbers, not in India but also globally. So there is a lot of progress which is happening on that front. And with most of the MNCs coming forward to explain their business models in transparent and a fair manner, and the authorities also equally appreciating the same. My only question remains is that when the same officer during an API visit and subsequent questionnaires and information is quite accommodative to appreciate the business realities. When he steps into the shoes of a transfer pricing officer, why can't he appreciate the same? So if the mindset changes that the transfer pricing law is something which would evolve over a period of time, but if the business mindset is developed, I think there can be lesser misery in the system. Because otherwise, of course, as we were rightly saying, that the count of the cases pending with the courts would keep on increasing. And then things like MAP may come to your rescue, but the rescue comes too late.
Okay, very interesting ideas, and litigation is again a subject which I'm sure can go on for a couple of more hours. Moving on to the other aspect of taxation, and taxation follows accounting. Not only that we see the changes are happening in the landscape, and with the global changes, the domestic taxation or maybe the court interpretations in the tax subject and the tax provisions, but even the accounting provisions which are getting impacted are also having some bearing on it. To discuss this further, we have with us Mr. Manik Malik. Sir, please let us know, how do you think about these new changes happening in the accounting standards, Ind AS or ICDS as we keep on hearing, and how do they sort of tend to have impact on the taxation regime, and how does industry think about all this?
Well, I think that's a huge subject in all fairness. I don't know, a couple of minutes, how much and what I can cover. So I will try and give real estate perspective to it. I think to start with, historically, we have accepted the fact that there are two books. One is an accounts book, one is a tax book. Now that parameter itself needs to be questioned. Why do we need to have our life so complicated? End of the day, we need to follow one particular method. Now, there is another layer which has been added of Ind AS. I think we are in a position wherein we accounted for certain profit in old accounting regime. We moved on from that regime. We have already paid tax on a profit. Now we were asked to reverse that profit and change the accounting standard and to again recognize the profit. So the profit got reversed through reserves. We are again booking same profit. And there is a risk that we are being taxed double on same profit. I've got no idea how to come around this situation. And we are even discussing these situations. There are notices being issued because of that. I think simply something that anyone will fail to understand. But from our point of view, the biggest aspect is POCM vis-a-vis percentage of completion. I do believe, I think some part of infra will also be facing same issues. It's just that a housing project that we are doing, we were earlier asked to recognize revenue on a basis on a particular percentage of completion. So every year before delivery, X quantum of revenue was recognized. Come Ind AS, and the requirement shifted towards recognition on completion basis. So entire profit was reversed, and we again had to recognize profit once the asset got completed. I think few of our colleagues have been getting few notices. So yeah, I think clearly, I do believe that we have few litigation experts. They will be able to get win a case on this aspect. But sheer wastage of time in this particular matter, I think it's just not worth it. Other related aspect relating to accounting, while obviously I think the subject requires, each industry has multi issues, but historically real estate is associated with multiple companies for various reasons. So, you ask me, US laws are quite simple. You have an option to file one consolidated returns. No issue of dividend, no issue of dividend tax, and life remains simple. So over here, you have to file tax returns at multiple levels. So creates its own complications. So yes, I think issues like MAT, fortunately, I think a lot of guys have moved away from it, but there were guys who were still left with credit. Now, once you are left with credit, and the same issue which I earlier spoke of, you are again getting profit on it in your books, and you are again recognizing you are paying MAT on the same old profit that you have paid. Stuff like that, then things like 11 UA, I think that one particular aspect, I'm sure everyone will have their concerns on. But very basic thing on 11 UA is that something like 43 CA or 50 CA, I think, wherein there is option from tax point of view that when the property is transacted, the circle rate has to be on the date of transaction. So if I am selling you a unit, you will purchase today. If I deliver it after 5 years and circle rate has gone up, say by 1.5x, you are not supposed to pay stamp duty on 1.5x. Now what's happening with 11 UA is that I am issuing you particular preference share, debentures, or I am issuing you an instrument today. It has to be valued today. I mean, every aspect in detailing of 11 UA, we are being made to value it on the date of conversion, and add to that in Ind AS, now following Ind AS.
Yes.
So say it's a preference share. Now half the preference share is accounted for in debenture, liability, and half is accounted for in equity. Now, from which factor do we divide it? I'll leave it to few tax experts over here. I don't know, honestly. So, but I think these are issues. In all fairness, the ask is quite simple. Make the tax simple.
Sure, sir. So very, very, eminent topic of compound financial instrument you touched upon. 11 UA and all these complexities put together leads to some unanswered situations. But let's hope it turns up well now. Sir, we have with us in panel Mr. Siddharth Goel. And Siddharth ji, along with all these discussions, one term which again is getting very, very popular these days is this new scheme and old scheme. And how do we see, I mean, what are these schemes and what exactly are they leading us to?
Hello, I'm audible?
Yes.
Yeah. Yogesh, adding to the point which Mohit has taken up, the Ind AS, as he rightly mentioned, whenever there is a change in the standard or accounting, you need to do something, changes in the reserves for taking the past adjustments. And under income tax, it gives impact on the MAT calculation for computing the book profit. Now coming to the new regime which government has come up for the domestic companies, since assessment year 17-18, they come up with a section called 115BA, which reduces the corporate tax rate from 30% to 25%. But under 115BA, the MAT provision still exists. Whereas in case of during the COVID period, they come up with a further new regime which is of 22%, which is for all taxpayers, not limited to manufacturing entity. Whereas 115BA 25% rate is only for manufacturing activity, with the debarring certain deductions which are common in all three sections, like section 35 and the losses or additional depreciation and other things for claiming the same. Same, they have come up with the section called 115BAB, which deals with the 15% tax rate for a manufacturing company who is setting up post 1st October 2019 and would be involved in a manufacturing activity in India. To Make in India, Modi ji has introduced this, although this can also be in a pillar 2 concept, which is going on at 15% tax rate, would be beneficial if somebody has opted for it, may be justifiable for that. But to my mind, there are certain restrictions and limitations while choosing these options. Like in option number A of 25%, you can claim certain deduction of Chapter 6A, which are not available in 22 and 15. Like lots of companies are having a CSR expense which they need to incur. If they donate those funds to a PM Care Fund or to a PM funds, they get 100% deductions also. Although in 37 the deduction is not allowable, but one can claim 100% deduction of those. But one has to do the mathematics and the cost benefit analysis while choosing the options. Once you choose the option of 22%, you cannot go back to anyone. Another challenge which is there is once you opt for a 22% and in due course you take some sort of a merger of an entity who is having a losses and having a tax rate of 25% or 30%, you need to work out the mathematics how to reduce those brought forward losses or depreciation, unabsorbed depreciation, which includes depreciation impact of additional depreciation or certain deduction which are restricted to those sections. This is again going to be another litigation which going to be there, because in ITR 6 of the current period, the column of elimination of those additional depreciation is not there practically for a taxpayer to offer for the taxation. But in law, it is there. That is my.
Sure, sir. And to extend this thought further, sir, so accounting and tax now somewhere also leads to an anomaly of somewhere the tax exempt receipts or receipts which are not per se income at all getting taxed. And we often see that under the Income Tax Act and under the MAT, which is again a mechanical provision, these kind of anomalies emerge. Anuj, would you like to share some little perspective on this particular topic? And just to complete this accounting and taxation related mix, I think it'll be interesting to hear your views on that particular subject.
Yes, Yogesh, I remember when I was pursuing CA final, so what we were given to understand in a comic sense that this was introduced to kind of curb one of the big Indian conglomerate. And whereas in international perspective, when I see this, then the understanding is given that after discussions happening in European Union to curb that profit shifting way back in 1989, this was introduced thereafter. But coming back to 115 JB, yes, there are certain deductions which are which we call as positive adjustment, and there are certain negative adjustments which are allowed to be made under explanation 1 to 115 JB. Now the point is, when there is a litigation arising out of 115 JB, whether a particular income which is treated as an income in the books of accounts and credited to P&L, whereas the same amount of receipt is not being treated as an income in income tax, whether there should be a perimeteria between these two, which means while computing MAT book profits, this amount should be excluded or not. There have been a lot of judgments on this issue. The latest one in this series is from, I think that is from Kolkata ITT bench, and that is Birla Corporation, wherein the principle has been upheld, although it's been widely accepted that if the receipt or the amount under consideration is not constituting an income under the Income Tax Act, then the same cannot be taxed under MAT also. So the underlying principle then comes is the receipt or the amount which is considered, is that making an income under section 2 subsection 24, which talks about the definition of income under Income Tax Act. Furthermore, the language which has been used in the explanation 1 to section 115 JB, that already talks about all the incomes which are falling under section 10, 11 or 12, those are to be excluded. So which means the exempt income is already outside that purview, specifically mentioned. However, if the receipt is not an income at all under Income Tax Act, then it can be excluded. So the underlying principle to me, in my view, is clear, although department is not ready to accept that and keeps on litigating on this same issue every time.
Sure. Thank you. So I think it's a very interesting thoughts emerging on the accounting and the related tax aspects of it. One more subject which I'm sure appeals to everyone are the TDS provisions. And if I kind of read the TDS and TCS provisions, then a beautiful anomaly of tax laws and so-called machinery provisions often emerges. Divya, would you like to tell us a little bit about how with everything being said, the policy level litigation attempts are being made to simplify, it's happening or not is a question, but how do the TDS and TCS provisions stand? Are they towards simplification, or what is the industry perspective to it?
See, the intent of the TDS provision was twofold. Earlier it was with respect to early collection of tax. Then it shifted to, to some extent to track the transaction. That is what is happening in the latest amendments with respect to 194Q and the TCS provisions of 206C1H. So the intent, the government is very clear, is to track the transaction, and hence these respective levies were introduced. The anomaly happened when the government started interconnecting these two. So now they said that, first TCS will apply, and if Oh, I'm sorry. The first TDS will apply, and if it is not there, then the other party will do TDS. And then now it's on the business to first of all track that whether the other party has complied or not. If they have not, then you need to comply. And if they have complied also, you need to report their challan numbers, etc. in your return. Now, data collection was government's job. It's been shifted to us in a very hectic manner. So this anomaly is kind of, difficult to match. So, and one more point here, interestingly, what we just realized is that if the intent was tracking the transaction, then all this is any which way is happening under the GST laws. There are various returns where the transactions are being tracked at, invoice level also. So all it needs to be done is that if, there can be some sort of data integration between the indirect tax authorities and the direct tax authorities, then that tracking solution could have been, solved. So of course the ask is simplification. Either the government should do nothing doing, period, TDS on all transactions, or nothing doing, period, TCS on all transactions. So if wish life was simple.
Sure, Divya, and I'm sure your words are very welcome to the technology companies who are trying to devise solutions around these complexities. But
Or
thanks.
maybe not, because then they would sell more if it's complex.
True. Umangji, how does the industry in India think about M&A? Is tax playing a pivotal role in driving M&A transactions more, or is tax becoming a brake in the car? And a lot of the M&A transactions are not happening because of the tax issues.
See, if you see the latest trend, of course, M&As in entirety had seen a break during the COVID times because the industry, the first thought was how to survive. But if you see the wave after the COVID, in last couple of years, the M&A transactions have been at its highest bloom. As far as tax is concerned, tax has been from time to time providing inputs into the mergers and acquisitions and divestments and demergers and the deals. So when I see this as a tax head, of course, the first and the most important endeavor is to how to minimize the tax cost associated with the merger or whatever structuring we are trying to do. So how to ensure that if we are doing a merger, it becomes like 100% revenue neutral kind of merger, so that tax neutral kind of merger. But there have been some developments which have shaken up things in recent past. To quote one of them is goodwill. So the recent amendment which happened a couple of years back, that the balancing figure or the premium which is paid as a part of the consideration, which we typically used to recognize as goodwill, shall not be entitled for depreciation. So I can understand the thought process behind the same, but the challenge is that let us try to assume it's an independent party transaction. In independent party transaction, the premium which is being paid is as per market forces. Now it may not be possible even to sort of tinker that premium amount because you're transacting at arm's length. And the challenge is that the moment you do such transactions, it is not always possible to sort of bifurcate all the intangibles, cut the cake into pieces. It may be marketing rights, it may be some dealer database, there may be n number of things which are intangibles and which you acquire as a part of the running business. So typically it used to be classified as a goodwill, and there was of course judgments like Smith Securities and others which entitle you to take the depreciation. But post this amendment, what has happened, since this depreciation is not allowed, so practically said and done, you are incurring a cost which is neither revenue expenditure nor a capital expenditure for you. And that is something which makes people to think now out of the box as to whether I'm acquiring goodwill or I'm acquiring actually the respective assets. So in the entire scheme of things, where it should have been more ease of doing business when certain roadblocks come into the picture like this, then of course we have to run our tax brains. No doubt it keeps us in the job, but it is more useful time of the people who sit across the desk and negotiate to structure the deal rather than actually tax trying to structure the deals. So this is just one example. Other than that, also there are often cases where there is a distinguishment between slump sale and itemized sale. For example, the tax department within themselves, for example, the income tax department might like to say that you have conducted a sale which is a slump, But when it goes to GST department, they find out that, oh, we do not get any taxes on the slum sale. So why we should not try to get this disintegrated into an itemized sale? Because that would fetch GST. So again, it's a policy matter that at the end of the day, the assessee, while negotiating the deal, have transacting the business as a whole and had not attributed the value to each and every asset. But perhaps, again, as we're seeing, only for the limited purpose of accounting, while we record the assets, we have to attribute value to each and every asset bought via slump deal. And someone using the same accounting report to say, no, you had attributed the value to the assets, so why I should not treat this as an itemized sale and levy a GST on the same. So again, it's very, very important that accounting and tax should join hands, and it should not be rather used against the assessee itself.
Great. So again, call for more simplification and clarification. Manik ji, does GAR, is the Indian industry supposed to be scared about GAR provisions? It's been discussed many times. How do you see it, sir?
Well, good thing about this question is you don't need to be a panelist to answer that. You ask anyone over here. So, yeah, I think we were always scared of implementation of this particular provision. We have always wondered. I think it's completely against the phenomena of ease of doing business. You are entering into a domain which actually is a territory that globally no one has actually seen. Now, anything and everything can be questioned. I think what we are seeking from authorities are simplification, and this is simply going against it. So I think, unfortunately, I think now that water is under the bridge, so we'll have to probably learn to accept it. I think our next battle becomes to reach out and to try and simplify with the provisions, whatever they are. So I think, again, on a couple of these items, what's arm length in GAR isn't really defined. I don't know, I think like from, like I previously stated a couple of sections, whether that's 50C or 43CA. What is it? I think if I am doing a merger, will a valuation, will it be circle rate? I don't know, all these rights that you need to ascribe to, how exactly you establish, how exactly you prove that, that's a big question mark. So, and again, the onus of proving it is simply upon us. Second aspect, it says that whatever be the taxation, if there's a profit earned as of today, only then it can be, a GAR can be applied. Now, what if I'm doing a merger and there's a profit in future? It's simply huge questions. I think we really will need to face it. The worst part about it is that now we have a committee around it. People have already started looking into, and the intent is to start issuing notices. I think simplest of thing from, I think if we say we are doing a particular merger, we don't have a body of advanced ruling, practically speaking. What other options we have? We go to tax authority. We are required to get tax NOC from every company that is under merger. Now that NOC, it reads, by the way, in case there is any provision for GAR, then I might catch you. So I'm giving you approval, but I might catch you again. And in fact, at separate levels, the discussion of catching that particular merger, for which we have received NOC from the same authority, is being discussed. I mean,
very similar to reassessment provisions, the backdoor entries.
I won't have much to comment about it, but again, a simple request that we need to relook at it. I don't think in this economy GAR provisions are required. I would suggest need to be rolled back, and I think even today for me to say that it needs to be simplified, it's slightly wrong, because the basis of provision is such that you just can't simplify it.
One of the irrelevant sort of provisions, at least in the present economic context.
Absolutely.
Maybe. Now, Abhishek ji, so we've heard the controversy so far, we've heard the request for simplifications, and yes, we are in 2023 and these are the industry requirements and perspectives to the entire thing. How do you see, sir, where is the need for the actual rationalization required in the tax system? And from healthcare, from a general industry perspective, how do you see, and where are the areas which you would like to mention that if someone key in the comment is listening, then what is the industry requirement exactly?
I think the frustration is coming out of honest taxpayers and the guy is responsible for tax compliance. So that's how we should look at it. In terms of rationalization and simplification, I think the biggest issue earlier was that how government has to do revenue planning when there were, no real-time data availability, and the lag and the lead, all those things need to be factored basis prior trend. But I think post arrival of 4G and then GST network and then demonetization, I think when we fill our own personal returns and the way things are, made available to you, which you yourself have forgotten that you have done it, during last year. So that kind of, backdrop, government has to do a very, very smart revenue management. So I'm sure all of us, work for some or the other corporate or our own enterprise, and we do our own revenue planning. So revenue planning basically has to be, done in the environment you are operating. And then you define your segments, your micro segments, and then basis the interrelationship between the segments, sub-segments, what kind of push and pull. You get a overall throughput, so you say 10%, 15%, 20%. Whatever is the gap, for that you need to introduce something new, to fill the gap, and that's how you keep, rotating the cycle. Same way government also does, but I think now they have been doing few things right. Like if you see the way the government receipts were there in budget, so 2021, which is not the right, I think, base year. So 21, 22, whatever figures I had read. So your total taxation was providing 66% of receipt, which improved to 70-odd% kind of thing, 22, 23. Figure might have gone up a bit, slightly, because estimates keep getting revised. So that way, I think they are getting more out of taxation system, which is reflected in buoyant GST collections and other things. And also in terms of the mix of the direct and indirect taxation, if you see. So I think the share means, what happens is ki out of 100 rupees what government receives as receipt, 70% is coming from taxation. And then this 70% further gets bifurcated between direct and indirect. So here what has happened is ki, the way India has progressed in terms of tax compliance, and the way government pressed button, in terms of lowering certain corporate tax rates, and also holding on to, the personal tax rates, but at the same time, providing ease of, compliance and, plugging some leakages. Approximately 5% share direct tax has gained. Again, 23 versus 2021 data may not be the right benchmark, but yeah, they have been able to move around 5% on direct. So first time direct tax is contributing 50% plus in total tax kitty. And indirect has gone down, despite we keep hearing GST, this, that, and other thing, but means with all that, they have been able to, not able to touch halfway line. Now, what I think government has to do is that they need to, go for plugging leakages in GST system and also bring down the rates further, so as to disincentivize, any kind of evasion or, to, have a compliance, A
more comprehensive approach towards and a better talking terms between the direct and indirect taxes, because Divya and other panelists also pointed out that the data is going in a consolidated manner.
Yes.
And I think it's need for a more comprehensive manner.
Yeah.
Siddharth ji, how do you think? Is this what is going to happen? Is this the real message, or you also see that with the international tax developments of BEPS and so many other things, new treaties, etc., even those global developments are also going to play a part on how the tax system will evolve in India? How do you see?
Considering the pillar 2 and other things which OECD and other things are going on, there would be changes more, as Mr. Mohit also mentioned about Agar. Those are the provision, anti-major provisions, they are there in the statutes, which internationally actually they are developing. That's why the GAR was introduced in our Indian Income Tax Act. So considering these, all these BEPS, profit shifting, these are the areas for which the more transparency and the data, quality of data collection is an important task for the taxpayer, as well as the government should take the data which are required from the taxpayers so that those things, BEPS and other things, litigation, global litigation can be avoided. These are the requirements as asked from the government from this.
Sure, sir. Great. So, Shailendra ji, now final comments on how does the Indian industry, what are at a general level are the key points from the Indian industry perspective to all our listeners, to the government, and what is it that we would really like to send a message to them?
So, as I mentioned, there's a plethora of growth opportunities, incentive schemes available in India, considering the large consumer base and the government also pushing for that. But, global investors are looking for a certain environment. I mean, for example, if I say, my holding company itself, so when we say for the, government incentive, they say, government commits something and you give this number, but we don't see the end number coming to that way, So that's the mindset, that's the impression they carry, perception they carry, So definitely looking for certain environment. So for that, I think there's a time for rationalization, simplification of the policies, simplified direct tax code, which was already in pipeline but has to be rolled out. We are looking for the continuous improved GST structure, a reduction is, compliance hurdle. We are also looking for the certainty on the simplified tariff structure, because we also feel being a tire manufacturer, we import complex raw material, chemicals, there's ambiguity about the tariff structure also, and the extension of the sunset clause for the new manufacturing units as well, lower tax rate. So these are a few specific things which we are looking for,
Right. Thank you. I think this is all what we had in panel for you. And I would like to thank to all the eminent speakers who joined in as a panelist. The tax is a subject which is individual to each one of us. And being in India, it has always been extremely robust. In 2023, we have come a long way. And the way we feel with the energy of the panel and each one of us here, it is going to be a very, very evolving landscape in the further years to come. With that thought, we thank once again to the panelists and to the audience for listening in to us and for the encouragement. Thanks once again, and to the organizers as well. So thank you. Thanks once again.